Marvell jumped 4.8%. Moat scores 64/100. Durable. The $216.1 billion market cap reflects its central role within the high-speed data center connectivity stack. At $240.42 per share, pricing still mirrors strong demand for its high-speed silicon, driving robust margins. The lab's teardown uncovers why Marvell's architecture outpaces rivals and fuels lasting growth for years to come. What operating evidence matters most for Marvell Technology Incorporated? The bull case for Marvell Technology rests on its central position within the high-speed data center connectivity stack. And another question, what could weaken Marvell Technology Inc.'s moat durability? Furthermore, Broadcom poses direct competitive pressure in custom silicon, while ongoing storage controller declines and erratic 5G carrier spending drag down total corporate operating margins to low levels. Walk the AI stack, and Marvell sits as a Tier 2 beneficiary, controlling custom silicon plus optical DSP interconnect. The moat here is design partnership, and it should hold for medium. On the cycle, this layer sits at peak. The one force that could crack it: Broadcom direct competition, ASIC market share, storage controller decline, 5G irregularity. Wall Street is pricing in profit expansion that the hardware margin compression contradicts. Marvell reported $2.42 billion in revenue, 28% year-over-year growth. Management delivered 80 cents in non-GAAP, non-generally accepted accounting principles, an adjusted metric that excludes stock-based compensation. Earnings per share against an 81-cent consensus estimate. Management missed expectations on the bottom line, yet the stock is rallying on aggressive forward guidance raises for its artificial intelligence infrastructure portfolio. The market is pricing in an expanding total addressable market for custom application-specific integrated circuits and high-speed optical chips, rotating capital out of legacy enterprise networking and into optical interconnect plays. Investors see Marvell's top-line acceleration outweighing weakness in legacy carrier and storage business lines. Wall Street sees rising cloud capital expenditures and prices in immediate profit expansion. But revenue growth doesn't guarantee profitability when hardware hits physical limits. Connecting massive artificial intelligence accelerator clusters requires optical transceivers powered by Marvell's Nova 1.6 terabit per second PAM 4 DSP, pulse amplitude modulation 4-level digital signal processor, a silicon microchip that converts high-speed digital signals into light pulses. Broadcom dominates high-capacity merchant switching with its Tomahawk architecture and holds the lion's share of Tier 1 cloud custom design wins, while Marvell competes with its modular 3nm physical layer IP. Intellectual property, pre-designed silicon circuit blocks ready for integration, blocks. Custom ASIC assembly carries dilutive gross margins compared to pure optical signal processor chips. Optical demand is booming, but packaging yield limits and lower custom silicon margins mean the top-line guidance raise won't deliver a matching surge in bottom-line profits. Quarterly financials showing modest revenue momentum for Marvell. Macroeconomic forces act as a double-edged sword, creating intense structural friction for Marvell Technology while simultaneously fueling its primary growth engine. The Federal Reserve has lowered its benchmark interest rate to 3.63%, while CPI, Consumer Price Index, a standard measure tracking average price changes in consumer goods and services, sits at 0.6% year-over-year, and unemployment stands at 4.1%. Meanwhile, the 10-year Treasury yield rests at 4.74%, driving a yield spread, the interest rate difference between long-term and short-term government bonds, of positive 0.50% as the yield curve continues normalizing. On Kalshire prediction markets, third-party probability context places the recession risk at just 6.0%. For Marvell, this interest rate environment directly dictates corporate capital allocation. Lower benchmark rates ease corporate debt financing costs, allowing cloud hyperscalers to fund massive capital expenditures. In recent earnings remarks, management highlighted how booming data center capex, capital expenditure, funds spent by companies to acquire or upgrade physical infrastructure, directly boosted quarterly revenue to $2.42 billion, up 27.6% year-over-year. However, high long-term treasury yields keep cost of capital elevated for legacy telecom operators. This financial pressure restricts research and development budgets, severely depressing Marvell's carrier infrastructure and storage controller segments. The macro wave is splitting Marvell's business in two. Capital is flowing rapidly into custom silicon design, while legacy enterprise lines suffer under high borrowing costs. Beyond interest rates, trade policy and regulatory friction are actively reshaping Marvell's market access. News headlines highlight escalating trade disputes, including newly restarted tariff friction between the United States and Canada, alongside rising political debates over national debt. While trade protectionism threatens global supply chains, government industrial policy and CHIPS Act create helpful incentives to produce semiconductors, a federal law granting billions in subsidies for domestic chip fabrication. Funding act as a powerful tailwind for domestic infrastructure. Marvell relies heavily on specialized domestic design talent to secure high-value design wins with American cloud giants. However, regulatory scrutiny on big tech capital spending poses an ongoing risk. If regulatory pressure slows down hyperscaler data center buildouts, Marvell's custom silicon ramp faces immediate pushback, exposing the company's vulnerable baseline earnings. Geopolitical tensions in East Asia represent the most critical single point of failure in Marvell's supply chain. Marvell operates as a fabless semiconductor designer, meaning it designs silicon architecture but relies entirely on third-party foundries for physical manufacturing. Supply chain data shows that leading indicator TSMC, Taiwan's semiconductor manufacturing company, the world's largest contract chip manufacturer, generated monthly revenue of 467.6 billion new Taiwan dollars, up significantly year over year. This massive sales jump demonstrates roaring underlying demand for advanced accelerator chips. However, Marvell's custom ASICs and optical signal processors depend entirely on TSMC's advanced manufacturing nodes in Taiwan and CoWoS advanced packaging capacity. Tight packaging capacity creates direct delivery bottlenecks for Marvell's product roadmaps. Furthermore, strict BS, Bureau of Industry and Security, the agency within the United States Department of Commerce that enforces trade sanctions and technology export controls. Export restrictions limit advanced silicon sales to China, capping Marvell's addressable international market. Any geopolitical disruption across the Taiwan Strait or tightening of United States export controls directly threatens Marvell's revenue delivery, turning regional stability into a fundamental financial variable. On the social and political front, public perception of artificial intelligence is shifting from awe to rigorous economic scrutiny. Investors and political commentators are questioning whether massive corporate investments in digital infrastructure will generate sustainable return on investment. This political backlash against big tech capital expenditure creates significant volatility for high beta stocks. Marvell carries a high beta, a statistical measure calculating how strongly a stock price swings relative to the broader market, of 2.25, making it more than twice as volatile as the broader S&P 500 index. When public sentiment turns skeptical toward corporate artificial intelligence budgets, Marvell experiences severe valuation multiple contraction. While artificial intelligence adoption accelerates across society, political scrutiny over power consumption and technological concentration creates continuous friction. Marvell sits directly in the path of these macroeconomic and geopolitical waves, where soaring infrastructure demand constantly collides with supply chain bottlenecks, export controls, and intense market volatility. At the lab, we trace hyperscaler capital spending straight into semiconductor top-line growth. Last quarter, total hyperscaler capex hit $110.8 billion, driven by Google Cloud's $44.9 billion, Microsoft Azure's $35.8 billion, and Meta's $30.1 billion spent. That immense infrastructure build directly translates into Marvell's balance sheet. MRVL delivered record revenue of $2.42 billion, up 28% year over year. As hyperscalers scale out AI clusters, every new rack demands Marvell's 800G and 1.6T electro-optics and custom silicon solutions. Marvell reported earnings per share of $0.80, missing the Wall Street estimate of $0.81 by 0.9%. a miss that raises questions about near-term guidance. Looking at Marvell's earnings track record over the last 4 quarters, the lab sees a clear pattern of razor-thin execution. After minor beats of 0.3% in September 2025 and 1.4% in December 2025, Marvell posted back-to-back EPS misses of -0.4% in March 2026 and -0.9% in June 2026, delivering 80 cents against an estimated 81 cents. Management sets guidance targets with virtually zero safety cushion, averaging a razor-thin 0.1% surprise across 4 tracked quarters. As Q2 results approach, history confirms Marvell trades almost exclusively on forward guidance trajectory rather than reporting day EPS prints. Marvell, custom ASIC networking, is trending higher at 240. Marvell delivered record first quarter fiscal 2027 revenue of $2.418 billion, up 28% year-over-year, and guided second quarter revenue to $2.7 billion at the midpoint, representing 35% year-over-year growth. Matt Murphy, Chairman and CEO, Q1 FY 2027 earnings release. Revenue accelerated 28%. GAAP earnings were 4 cents. The gap between those numbers is the entire story. Management celebrates top-line growth and custom infrastructure wins, but the filing reveals a different truth. Let's decode what actually matters. Inside that earnings release, management highlighted 80 cents in non-GAAP EPS. But open the legal filing. GAAP diluted EPS was just 4 cents per share. Management reported GAAP gross margin of 52.1%, while promoting a non-GAAP gross margin of 58.9%. Massive stock-based compensation and acquisition adjustments bridge that gap. Adjustments hide the real margin. While leadership preached accelerating quarterly momentum, corporate insiders quietly took profits. When executives preach long-term hypergrowth to retail investors while liquidating personal equity, watch their transactions. Institutional shorts are tracking this mismatch too. Short-marked volume recently accounted for 40.7% of daily trading volume, according to FINRA. Insiders know something Wall Street doesn't. Trading action reflects aggressive options positioning and momentum buying ahead of upcoming earnings. Yet the structural underlying economics tell a far more cautious story. The trades don't match the fundamentals. What management is saying, AI bookings drive record demand. What the lab hears, custom chip customer concentration drains margin faster than top-line grows. Now examine the language shift hidden inside the Form 10-Q. While executive speeches focus on winning custom cloud contracts, the official risk factors section adds explicit warnings about custom engineering revenue. Management specifically added warnings regarding risks related to failures of our customers to agree to pay for NRE costs, failure to pay enough to cover the costs we incur, or non-payment of previously agreed NRE costs. The fine print contradicts the pitch. That legal addition signals shifting leverage. Cloud giants hold immense bargaining power. If custom ASIC projects face delays or cost overruns, hyperscalers force Marvell to swallow the financial expense. That is a massive operational burn required just to keep pace with custom silicon rivals. Marvell absorbs the risk, not the customer. Institutional capital flows from 13F filings, reveal smart money division. FMR LLC slashed its equity position by 57%. Meanwhile, State Street and Vanguard expanded holdings. Smart money exiting early recognizes the drag from legacy storage controller decline and erratic 5G infrastructure demand. Underperforming legacy lines are actively subsidizing custom chip development. Legacy cash covers new bets. Wall Street prices the company on massive custom chip addressable market expansion. If GAAP net income fails to convert while NRE cost warnings remain in SEC filings, the bull thesis breaks. One metric failure ends the case. The momentum breakdown for Marvell. RSI sits at 61, pointing to bullish momentum with buyers in control. MACD is currently bullish, with the histogram crossing above zero. The bull case for Marvell Technology rests on its central position within the high-speed data center connectivity stack, operating as a crucial supplier in custom ASICs, application-specific integrated circuits, tailored semiconductor microchips designed for proprietary workloads, and electro-optics. Marvell is capturing massive spend as hyperscalers expand custom silicon programs. Marvell's physical layer interconnect IP, intellectual property, pre-verified circuit design blocks, creates high switching costs because integrating these blocks into cloud architectures requires multi-year co-design cycles. Supported by a bullish MACD, moving average convergence divergence, a momentum indicator showing the relationship between two moving averages, crossover and an RSI, relative strength index, a technical momentum oscillator measuring the speed of price movements, of 61.2. Technical accumulation is forming a rounded bottom pattern above moving averages. Options positioning confirms this institutional interest with a put-to-call ratio, a sentiment metric comparing put option trading volume against call option volume, of 0.50, dominated by 40,808 call contracts and heavy strike activity at $240 and $250. However, the bear case highlights a severe operational disconnect between headline revenue growth and actual GAAP, generally accepted accounting principles, the standard legal framework for financial accounting, profitability. Trading at a trailing P/E, price-to-earnings ratio, a valuation metric dividing stock price by annual earnings per share, of 82.6 times, and a forward P/E of 38.3 times. Marvell carries a premium valuation with zero safety buffer. While top-line revenue expanded 27.6% year-over-year to $2.42 billion, GAAP diluted net income per share came in at a razor-thin 4 cents, compared to non-GAAP earnings of 80 cents per share. Institutional positioning reflects this sharp divide. While standing 13F filings from Show State Street expanding its stake by 79% and Vanguard adding 48%, FMR LLC aggressively trimmed its holdings by 57%. Furthermore, Broadcom poses direct competitive pressure in custom silicon, while ongoing storage controller declines and erratic 5G carrier spending drag down total corporate operating margins to low levels. Here is the pro-level question cutting through corporate public relations. Can Marvell convert 28% top-line optical revenue growth into GAAP diluted net income expansion before custom ASIC margin compression and legacy revenue decay overwhelm corporate cash flows? The lab's answer is clear. Non-GAAP metrics obscure massive stock-based compensation and restructuring costs that dilute equity holders. Hyperscalers actively pit Marvell against Broadcom to negotiate lower custom chip prices. While 82.6% of revenue now stems from hypergrowth data center segments, custom silicon assembly carries significantly lower gross margins than standard optical signal processors. Unless Marvell scales GAAP earnings conversion, top-line growth is merely subsidizing underperforming legacy business units. A sustained breakout above immediate resistance at $253 confirms that institutional capital is looking past GAAP earnings dilution to price in long-term custom silicon dominance. Conversely, a breakdown below major technical support at $163 invalidates the post-earnings accumulation pattern, signaling that margin compression has taken control. If Marvell expands its data center gross margins above 60%, while lifting GAAP diluted earnings per share above 30 cents, it proves that optical demand is generating true structural profitability. If custom ASIC margins compress below low levels due to Broadcom competition while legacy storage continues declining, it exposes severe moat erosion. Marvell carries a moat durability score of 64 out of 100, reflecting a solid hardware franchise that remains constrained by heavy execution risks and structural margin pressure. Here's the macro picture shaping Marvell. Strict BS export controls limit advanced silicon sales to China, though Marvell's primary risk remains heavy TS. Marvell is operating at the absolute crest of the AI infrastructure cycle. Management aggressively frames its trajectory around high-margin custom ASICs and 1.6T optical interconnects, anchored by its key partnership with Google. However, We see elevated options volatility pricing in a 10% earnings move while insiders take profits. Over the next 2 quarters, Marvell must deliver flawless execution on custom silicon ramps to support this valuation before cycle deceleration sets in. Marvell's 5nm data center switch ramp is the only signal that matters. Is the bull case or bear case stronger for MRVL? Drop your thesis in the comments. This isn't financial advice, just engineering-level analysis for education. Markets move fast. Past performance doesn't predict future results, and you should always do your own research before trading. Subscribe to get these deep dives before Wall Street catches on. If you want our full breakdown on Rocket Lab, the link is in the description. Stay sharp, engineers.